Hello, everyone. This is Skorupinski with you today, and I'm excited to be welcoming you officially to Online Trading Campus and to the first module of our new Campus Blueprint course. Before we jump into the first module, let us first spend some time on this slide right here. This Blueprint strategy course is designed to be an all-encompassing strategy course. What I mean by that is that we will not just cover supply and demand, but the strategy course entails three major pillars or sub-strategies, if you will, that put together in the right place will form the entirety of the Blueprint course and the Blueprint strategy. Of course, we will start this course off by covering supply and demand, and supply and demand will form the foundation of the overall Blueprint strategy. Supply and demand is the foundation of the Blueprint strategy because it's universal. It's universal to all assets and markets. Whether you're a preferred gold trader or crude oil trader, or whether your favorite markets are Forex or crypto, supply and demand is universally applicable to all markets. Supply and demand is also universal to all income goals, whether you want to focus on short-term income, medium-term income, or long-term wealth. Supply and demand is, again, universally applicable to all income goals. And with the help of supply and demand, you will acquire the skill of timing the markets. Being able to accurately get in and out of the markets with high probability, low risk, and high reward trade setups. But, and here's the catch, just because you're able to time the markets doesn't necessarily mean that you're able to predict the markets. There's a difference. Now, let me explain this. Supply and demand is an analysis based on price. And if you want to be able to predict price, you need to know what drives price. And if you were to answer the question of what drives price with the answer price, then that's kind of a circular reference and a fallacy. Price cannot drive price. In fact, it's fundamentals that drive price. And that's exactly where the next pillar or sub-strategy of the overall Blueprint strategy comes into play. At Online Trading Campus, we have developed proprietary and well-seasoned fundamental forecasting tools that have a very robust track record of predicting the future. And in this course, I will start introducing those fundamental indicators very, very early. Now, the minute I start to introduce those fundamentals, the problem is that the conversation that we're having all of a sudden becomes much more complex, because contrary to supply and demand, which is universal to all markets, fundamentals depend on the markets we trade. And not all markets underlie the same fundamental conditions. And therefore, different markets have different fundamental drivers. Now it's our job to figure out which fundamentals really matter and which fundamentals don't really matter. And this may take a long time, but here's the good news. Once you understand the fundamental drivers of the markets you trade, then you understand what moves price. And if you know what moves price, then you can predict major rallies and declines before they happen. Now, once you can predict major rallies or declines before they happen, you can look to position yourself early before the market completely takes off. And this is where, again, circling back to supply and demand, where supply and demand will come back into play, as you will then use the power of supply and demand to time the markets consistently and accurately. Now, if you are new to the campus and this is all a lot of information at once, no worries. And no worries if you're not following this. We will cover all of these pillars in a lot of detail throughout this entire course. To me, it is important though, in the beginning already, to give you a general concept of the blueprint strategy and how we can combine different, let's call them sub-strategies, mainly technicals and fundamentals, into one overall blueprint strategy. Now, the last pillar is a very interesting pillar. The last pillar of our blueprint strategy is what we call campus strategy optimization. Campus strategy optimization is an innovative software that we developed and launched late last year and, well, actually early this year. Let me explain this in a little more detail before we move on. If you think about, let's say, the last 10 or 20 years, then you can probably agree with me that technology and innovation, computers and phones, and now also AI, by the way, have changed the way we act, they change the way we think, and they change the way we make decisions every day. But in the financial world, there has been very little to, let's say, no progress whatsoever. That's odd, isn't it? Data and knowledge is so readily available at your fingertips. You can ask Siri, you can ask Google. And since this year, I think a little bit longer than this year, since maybe already 3 months, you can also ask ChatGPT to answer any of the questions you have. And you may have tried that already. I know I did. And so I actually tried asking ChatGPT the other day whether or not I should buy gold. And the answer that I got was very vague. It was about saving money, and it was about, it was telling me to seek advice and to seek financial advice and to seek out financial advisors. And it was telling me that it's a language model and that it cannot predict the markets. I could also ask Siri, so, hey Siri, should I buy gold today? And it's just telling me, sorry, I can't get the information about that commodity. Usually it tells me that it doesn't really get my question, but she's just quiet today. So also Siri can help me. And so you can see, and you can try that yourself, there's very little to no innovation in the field of the financial markets. Now, wouldn't it be nice though to have the computer look at thousands and hundreds of thousands of relevant financial data points, then filter those data points through sophisticated calculations, backtests, and logic, and based on those computerized calculations, then spit out potentially profitable trade opportunities. Now, that is exactly what the campus strategy optimization software is supposed to do. It uses the powerful machines that we're sitting in front of, and it works kind of like an answering machine. And that's good because in trading, you may have a lot of questions, especially if you're new to trading. You may have a lot of questions like, When should I buy? At what price should I buy? What should be the stop loss that I should use? How many days should I be holding a specific trade? And what's the expected profitability of that trade idea? And all of these questions are questions that the strategy optimizer answers. Now, to drive this home with an analogy, for those of you that have seen Iron Man, that analogy will make sense. So Jarvis would be the equivalent of this software. In very easy terminology, it's an answering machine like Google or Siri, but it focuses on the financial markets. All right, so all of these pillars that you've just seen combined, put together at the right place of the analysis, will form a strong foundation for trading and investing. And in fact, it will form a strong foundation for trading and investing for any market you can think of. What you want to do is you want to use the large amount of data you have access to, and you want to use the powerful machines you're sitting in front of to the best of your capability. And that's my goal for this entire course. My goal in this course is to give you advanced tools and knowledge about the markets we trade, so you can make sound financial decisions and choices for your future. I want to give you access to powerful strategies and well-seasoned forecasting tools, as well as innovative trading software. All right, so with that out of the way, I want to welcome everyone to Module 1, Campus Strategy 101. Module 1 will build on a lot we just covered conceptually. We will cover it now in a lot of detail. Moving on to the agenda. First, we're going to talk about technicals versus fundamentals, followed by answering a question that I get a lot, which is, what is a good trader? And therefore also answering the question, what a good trade consists of. Then we'll categorize our markets into finite versus infinite markets. And that is because we trade many markets, and not all markets, as mentioned before, have the same underlying fundamental conditions. Here, what we need to do is we need to categorize the different assets we trade to ensure we are applying the right fundamental forecasting tools for the markets we trade. And so what I will do is I will give you a table later on that covers our strategy pillars and tells you what analysis we should focus on for each market. We will then wrap this module up by talking about the strategy process. Here, we will conceptually cover each step of the analysis you will look at and all the questions you will ask when analyzing any market. And at last, for those of you that are new to the online trading campus, I want to talk to you about your trading journey with us. What is required in terms of your trading setup and what awaits you in the future. So it all boils down to the right analysis, doesn't it? Which one should we follow? And while this may be a simple question, the answer, unfortunately, is much more complex. In trading, there are two camps, and both camps claim that they have the superior strategy. There is the technical chart analyst and the fundamental analyst. Technical analysis is most widely used by traders today. supply and demand is a technical analysis because it is based on price and chart patterns or formations. Technical analysis could also be based on volume or moving averages. Now, these would be very outdated and bad examples, in my opinion, of analyzing price because they're more than 50 years old. Now, don't get me wrong, I'm not saying that they are completely wrong, and some of them may find their way also into our analysis at times, but today there are much better ways of analyzing price. And the most accurate way of defining and analyzing price is supply and demand. Here is what the technical chart analyst will claim. They will claim that the chart and price will tell you everything there is to know about trading. I disagree. In my opinion, technical analysis should be mostly used to find good entries and stops and targets. In other words, technical analysis should be used to time the markets, to become masters at timing the market. And supply and demand is the most powerful technical analysis we can use to time the markets most consistently and most accurately. Here's the issue with supply and demand. Supply and demand, however, does not really tell us what the best markets may be to focus on right now. What I mean by that is that there are more predictive tools out there than supply and demand. And I believe that these tools are found when actually looking at the fundamental conditions of the markets we trade. Fundamentals will help us in determining whether we can expect a substantial move or not. Now, fundamentals, there are many things we could look at. And I think most problematic with most fundamental strategies is that the numbers, let's say, on physical supply and demand inventories of commodities, for example, they can change quickly. And, you know, these numbers are subjective and it depends on the interpretation of the trader, and what you may think is bullish may be bearish to another person's point of view. And this is exactly the reason and the argument why most technicians avoid fundamentals. Therefore, what we need to achieve is to find fundamental ways of analyzing the markets that are not subjective, that are as objective as possible. And there are ways on how this can be done. And this is where the Campos indicators will come into play. The Campos COT index, Campos valuation, and Campos true seasonality are all well-seasoned forecasting tools that show a very accurate track record of predicting the future. All right, so the technical chart analysis is objective and it's universally applicable to all markets. Technicals are powerful for market timing. Fundamentals lack market timing, but they are much more predictive of when major market moves may take place in the future. Remember, fundamentals drive price. So why don't we combine the best of both worlds? A question that I get a lot is, what is a good trader? Good traders are good decision makers. They make decisions every day. Even if we decide not to trade, that's an active decision, isn't it? That, I'm sure you can agree, sometimes can be even more difficult than to trade. So good traders are good decision makers. They make future predictions based on a study of the past. They understand the fundamental drivers of the markets they trade, and above all, they're good money managers. So let me put this in other words. They know and understand what drives price, the fundamental condition. They have a way of timing the market with an adequate risk-to-reward proposition. That's where supply and demand comes into play. So it's supply and demand that will allow us to be good money managers through risk-to-reward propositions and good entries and good stops and good targets. And it's the fundamental forecasting tools that will allow us to predict the future. That brings us to this slide, which answers what a good trade needs to consist of. And every trade should consist of two elements: the underlying fundamental condition of the market, the so-called setup. We can determine a good setup by using our compass indicators. But remember, when a market sets up fundamentally, it will not tell us at which price to buy or sell. And so after a market sets up, we then want to go ahead and time that market with a quality risk-to-reward proposition before it completely takes off. We then use our market timing tools to tell us at which price to buy or sell. And this is where we use supply and demand to accurately get in and out of the markets by placing quality entries, quality stops, and quality targets. To most people, trading is an unsolved puzzle. And there are many puzzle pieces, in fact, that we must put together in the right place to become good traders. And all of you may be at different phases of figuring out this puzzle. You may have just started with Online Trading Campus and you are learning, you're studying, or you're acquiring the knowledge of what strategies to use. You may have already studied the course material and you're already practicing and backtesting. Now, important here, you can only transfer the knowledge from the course material into a skill, right? Transferring knowledge into a skill that you can apply through practical applications and backtesting. So you will look at both the fundamental condition of the markets you trade, and you will analyze the markets based on technical analysis by using supply and demand. And once you've done that, you then need to take a decision of whether to take a certain trade or whether not to trade. And after a trade has played out, let's say you decided to take a certain trade, and after that trade has played out for better or for worse, your job is not yet done. Then you still want to log the trade you've taken and review your trade log. And that can only be done, let's say, after you've a good sample size of 10 or 20 trades. This right here is an important and often overlooked step, as it gives you instant and objective feedback on what you may be doing wrong and what you're doing extremely well. And by the way, the puzzle does not even stop there. There are going to be asset classes for you to gain further insights into. There is a futures, there's a Forex, there's a stocks course, there's a business plan that you want to write. There are milestones you want to achieve to scale up your business. And there's the mental game that you want to stay on top of course, all the time. To all these topics, you will find courses online within the classroom pillar of the Online Trading Campus. Now, this is an interesting slide. We trade many markets and we trade various assets, and we know that not all of them are the same. There's a big fundamental difference in the markets that we trade. And I believe that the difference comes with the major participants of these markets. These large participants, let's call them institutional participants, are the participants that we want to align our trades with. We want to buy when they're buying, and we want to sell when they're selling. Therefore, it does make sense to understand who those big guys are and how and when they generally operate in these markets that we trade. Right, so what we want to understand, or what we have to understand, is the following. We can categorize all of our markets into finite versus infinite markets. And there will even be a third category that we call man-made commodities. Now, let me explain this in a lot of detail. Finite markets are the easiest to explain. Finite markets are commodities like sugar or wheat, and infinite markets are markets like stocks or equity indices. The lifespan of a commodity like sugar is extremely short. It goes from producers to users, and then it's all over. Sugar and cacao, for example, would be made into chocolate. Wheat would be made into flour. What else? Gold and silver, they're used for computer chips or nice jewelry. Crude oil, of course, or natural gas are made into energy. And so all of these commodities, they have one thing in common. They're finite. They go from producers to users, and then it's all over. Now, it makes sense that the key institutional participants for these commodities are exactly these people, the users and producers of commodities. These will be the guys that you will learn to pay very, very close attention to. We also call them commercials. Commercials usually, they buy weakness, they sell strength, because they do not speculate like you and I, right? We are speculators in the game. They're not speculators. They're trading millions of dollars of real product, and they're in this business to facilitate those business activities through the futures market. And then this is how they make money. And that is why I believe they are the most important group for us to follow when it comes to finite markets. They're, by the way, also the biggest, and they're the smartest player in the game. Their business of trading millions of dollars of real product relies on their ability to buy and sell that particular commodity at the most advantageous prices. Now, the assets that are included under this finite market category are energies like crude oil or natural gas, precious metals like gold and silver, palladium or platinum. We have grains like wheat and soybeans. We have livestock like live cattle or lean hogs, and the list goes on and on and on and on. What's important here is for you not to memorize the markets all one by one, but really to memorize why a market is part of the finite category. Because you could add rice, you could add orange juice, you could add lumber, right? And the list would go on, and I couldn't make as long of a list here. The influence of what drives these markets, it must be the true physical supply and demand, right? Because gold miners, they cannot just print more gold whenever they want, and the supply is limited, and there will always be demand. For stocks, on the other hand, moving to stocks, we can categorize them into